your face is not going to show up on it, but that's okay.
That's just as well. Age, no sense spreading it around.
Yeah, exactly.
So can you hear me okay? I'm a little far from the speakerphone we got set up for you.
I'm sorry?
Yeah, okay, that answers my question. I just want to make sure that I'm close enough, Gary, to you so that you can hear me through the speakerphone, hear my questions.
Yeah, that's a little clearer. It was a little muffled.
Muffled there. Okay, all right. I will move around a little bit to make sure that that I come in loud and clear.
Loud and clear. All right. If you guys are ready, we'll go ahead and start.
How much of your time do we have this afternoon, Gary?
I actually have to be home in about an hour and a half, and it's the ferry or the bus. I would say until does 4:30 work for you, or is that?
Oh, that's perfect.
That's perfect. Yeah, absolutely.
All right. So if you're ready, we will we'll start now. Here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hoff of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate. That certificate's not given away by the radio station, but by Tanbella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is TV and film. Now, we have a special guest on the phone. We've had him on at least twice. Gary Schlossberg, who is Wells Fargo's chief economist. And Gary, we are absolutely honored to have you on the show today.
Well, thanks for having me along.
Hey, Gary, I think the topic of the week would probably be somewhat obvious, and that is interest rates. And it's amazing, Edward and I have been doing this show for 8 years now. And we do shows at the beginning of the year where we talk about, who's predicting where rates in the economy are going. And I think for the last 5 years in a row,
we've all been wrong.
The pundits have all predicted, 5% mortgage rates by the end of the year. And here we are now talking about mortgage rates maybe dipping down once again. Are you surprised by what's going on in the economy this year?
Well, we've been calling for higher interest rates over the past several years, that on the assumption that inflation would eventually stabilize, turn the corner a bit. This year, though, early on, it was clear that rates would be moving lower. The Federal Reserve shifted gears. It became what we call more dovish, becoming increasingly clear, transparent about actually lowering rates. And the reason for that was all the uncertainty out there over slowing growth overseas, the trade war with China, the fact that inflation never really did come around. It was percolating for a while, but really has stayed down, and that helps drive long-term rates, to which the fixed rate mortgage is tied, particularly the 10-year yield. So a couple of things came together, and it was clear early in the year that once again we were headed in the wrong direction, at least in terms of our forecast. Great for a home buyer, though.
Yeah. So one of the things, I was reading a blog this morning, actually, and they were talking about negative yields overseas, like in Germany and Japan. And one of the reasons that this gentleman was giving was there's a lot of retiree money that's sitting in cash, sitting in their banks. And yet there's not enough younger people who are borrowing. So the banks can't pay interest if they're not earning interest.
Well, certainly the demographics aren't helping in terms of home buying, other borrowing, although Europe, I think, historically has been a little more conservative, certainly households, than households here about taking on debt. But really, I think more of it is simply the fact that economic growth there is weak. Part of that, again, demographics and aging population, slower population growth, but a slower recovery from the financial meltdown 10 years ago as well. And the central bank has been responding to that by becoming even more aggressive over the years than our own Federal Reserve, and actually buying up securities longer and more aggressively than our central bank. In fact, there's every indication that they'll be back at it again after ending the program, back at it again late this year, early in 2020.
Well, that's one of the reasons that our interest rates are going down, is that they're buying a lot of our treasuries, right?
Exactly. The negative yields have had a spillover effect. Money is what we call fungible. It moves around very easily, and negative yields aren't all that attractive to investors. There are reasons why investors in Europe are continuing to buy negative yielding securities.
Yeah, go ahead and explain that to it. Because I'm looking at it and I'm going, I make more money putting it under a mattress than I do putting it in the bank. That doesn't make sense.
That's only if you hold the security to maturity. If you still think that or if you think that economic growth is going to be very weak there, the economy falling into a recession, inflation and inflation expectations moving lower, the central bank still very stimulative and pumping money into the system, then those rates could become even more negative, as they will if, as we expect, the European Central Bank comes in and actually lowers rates from where they are now. In other words, making them more negative. As rates move lower or even become increasingly negative, bond prices benefit from that. So there is the issue of trading profits. You can still make a price gain. In other words, bonds are becoming more and more like stocks. Most of the return coming from price changes, less from interest rates. The other element out there is that if you are so fearful of the outlook, better to lock in a loss now than take your chance with another security in Europe, for example, or anywhere else for that matter, if you're really frightened of the financial markets. And there is a certain amount of locking effect as well. So you can see where investors might be inclined to continue investing in those securities. On top of that, banks, pension funds, insurance companies, particularly in Europe, do have to hold a certain amount of government securities, or at least are inclined to. And so even as those yields turn negative, they may shave their allocation, but they still will hold a certain amount of those securities. Now, back to the earlier question, money does move around with negative yields. All those other investors that really don't have to take those negative yields will move to where yields are still positive. And one of the biggest markets, of course, is in the U.S. So even though our yields are lower, at least they're positive. You get foreign money moving in, it drives the price of the security up, and that drives the yield down a bit. One reason, incidentally, why we have what's called a negative yield, an inverted yield curve, but we can get into that later if you'd like.
Yeah, I was going to say, we have to cut to a commercial break. When we get into that, we'll get into that next commercial break. Or
next segment.
Next segment. Thank you very much. Okay, so we're talking here TV and film trivia question number 1. And Gary, if you know the answer, don't say anything until we get back.
Okay.
In the TV show Shark Tank, who gave the nickname Mr. Wonderful to Kevin O'Leary? All right, so you have to know the show for that one. Call 888-912-1190. Be the first caller with the correct answer. You're going to win that tanning certificate. In the TV show Shark Tank, who gave the nickname Mr. Wonderful to Kevin O'Leary? Stay with us. You're listening to The Best of Investing. I'm Edward Brown with Mark Hanf and our special guest, Wells Fargo Chief Economist, Gary Schlossberg. Don't touch that dial. We're going to be right back. All right, that was a good first segment.
Okay, good.
Good.
Let's move while we're ahead.
Yeah,
that's right.
I still can't understand. I don't know if they have safe deposit boxes. They must have them in other countries. You'd be better off to just put all your money in a safe deposit box.
Well, that's true if you're, again, holding to maturity, whatever that maturity is. And it's a good point, actually, because as those yields become increasingly negative, at some point, many investors, not those, for trading profits, but those, for example, who are concerned about losses, will put their money in cash, as cumbersome as it might be, rather than lock in losses in a longer dated security, as those losses exceed anything they might expect in investing in other securities. Remember, I said that was one reason why investors might, to a point, invest in negative yielding securities.
Right.
What you know than what you don't know. But again, there is a limit to that, and that's when cash comes in.
And I can't imagine you would ever invest in a negative yield.
Well, I would if I was a trader, but I'm not. So,
to go even more negative. There you go. All right.
Our next segment's 9 minutes, Gary, so we've got a little bit of time to go.
Yeah, because I want to talk about the inverted yield curve, and I kind of remember from the late 70s.
You want to start with that?
Yeah.
And that's an interesting point. That's the advantage of being a dinosaur like I am.
That's right. Yeah, like me too.
Well, I remember when curves inverted, but they inverted as short rates rose more rapidly than long rates, not long rates falling more rapidly than short rates.
Yep.
And in fact, banks now benefit from rising yields in their net interest margin.
Well, we'll get into that. Let's go ahead. Okay, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and our special guest, Gary Schlossberg. First trivia question. On the TV show Shark Tank, who gave the nickname Mr. Wonderful to Kevin O'Leary?
Was that Mark Cuban?
No.
It wasn't.
No, it was before he got on the show.
Barbara Corcoran?
Well, yes, Barbara Corcoran. Yes, because, oh, you're just Mr. Wonderful, aren't you? All right, so on the phone, we have Wells Fargo Chief Economist Gary Schlossberg. And Gary, we sort of teased the audience when we were exiting the last segment about inverted yield curves. And I remember being in college, and at the time, you could get 16% on a money market fund from an FDIC insured bank. But if you wanted to go longer term, like a treasury bond, which can theoretically everything's guaranteed by the government in this instance, it was like 12 or 9%. And I'm going, wait a minute, short term rates are high and long term rates are low. What's going on? And someone had to explain this inverted yield curve, which basically meant investors and everybody were expecting yields to drop.
Right. Those yields expected to drop, and in fact, the inverted yield curve has done a very good job over the years of anticipating an economic slowdown. There have been times when the curve has inverted, 1998, for example, and the economy didn't roll over into a recession. But typically, historically, it's been a good predictor, and certainly is a yellow flag this time around as well. Good predictor because short rates, as you pointed out, were rising more rapidly than long rates. The Federal Reserve chasing inflation, and that's one difference between then and now, chasing higher inflation, trying to stay out in front of that, what we call the inflation curve. And as they continue to do that, investors anticipating a slowing economy and leveling out and a decline in inflation, at least temporarily, it demanded less for their longer dated securities, less yield, or at least the yield leveled out. Now, keep in mind that there was still an advantage in locking in those yields because they would persist for a while, whereas if you were in a money fund, once the Federal Reserve stopped raising rates, those short-term interest rates, geared very much to what the Fed's doing, would be coming down. So even at a lower yield, it paid to lock in a longer-dated security. Now, flash forward to the current situation. Certainly, the inverted curve could be signaling a slowing economy and investors demanding less yield because of an anticipated economic slowdown and lower inflation. However, the difference this time around is that the Federal Reserve isn't chasing higher inflation. In fact, the Federal Reserve is easing policy. It's cutting interest rates. Longer-term rates are falling more rapidly than the decline in money market rates. The Federal Reserve has only begun to cut rates, we assume, making that first cut in a decade back at the end of July. But the bond market is seeing those yields falling more rapidly. Now, certainly some of that may be due to concern about the outlook, but keep in mind as well, lower inflation and reduced inflation expectations could be due to factors other than the expectation of a slowing economy. In fact, when rates are declining, that's the big difference now compared to historically, when the curve was inverting with higher rates. With rates coming down, you would think that would ease the pressure and reduce the risk of an economic slowdown. So that to me is one difference. You never want to say it's different this time, but there is a difference in the backdrop. The other thing gets back to the other element there gets back to that foreign demand of Treasury securities. That may be driving those long-term rates lower as well. But really, fundamentally, the difference is that this inverted curve, is occurring amid declining rates, not rising rates. And of course, that has implications for banks as well.
And you don't see a negative yield coming to America, mostly because there's still a lot of demand for debt, right?
Well, it's for that reason that you could see yields continue to move lower. We're not that far above zero. Yeah. Some analysts are expecting yields on longer dated securities to approach zero, much like they are in Europe. But that would be due in large part, I think, to foreign demand. It could also be due to inflation coming down here. I wouldn't look for a big drop in inflation, enough sufficient to bring that rate down, the bond yield down to zero or below that. But you never want to say never.
I mean, I would love to be able to go to the bank and borrow on 30-year money at 0% on my house.
Yeah, well, that's what the Federal Reserve is trying to avoid. They don't want
don't avoid it.
those rates down. Well, it does have a negative side effect, because when yields are negative, banks aren't making money on an inverted curve when when you have a negative spread between the cost of their borrowing, funding, and the cost and the yield that they're making on a loan. So what you're finding is that lending in Europe, which for corporations, incidentally, those corporations are more dependent on bank loans than bonds than they are here in the U.S. But one reason for weak lending activity in Europe may be due to the fact that the margins there aren't all that attractive. Banks are looking for other ways to make money. So it comes under careful what you wish for. Those negative yields may look attractive to a borrower, but it's getting the money that could be a bit more problematic. It creates distortions in the financial markets that I think we'd be better off avoiding. Our yields are low. No sense asking for more than that.
Gary, let's pivot a bit. Given what we're seeing happening in the economy right now with both short-term and potentially long-term interest rates declining, which definitely was not what we were predicting at the beginning of the year, how has that adjusted your forecast for what you see potentially happening in 2020?
Well, to some extent, it certainly lessens the risk of a recession. However, to the extent that this reflects not only a weakening economy, and over the past couple of months, we have become a little more concerned about the outlook, but it also, and I'll get into why in a moment, but it's really related in part to the other element there, the uncertainty created by this trade war, by the slowing growth overseas, the kinds of things that the Federal Reserve was talking about and justifying its rate cut at the end of July. The economy seemed to be holding up a bit better then, but over the past couple of weeks, we've been seeing a little bit of spillover from the weakness in what we call trade-sensitive areas of the economy, notably manufacturing, business investment, which is tied to some extent, particularly for the big multinational companies, to what's happening overseas. We've seen some spillover from the weakness there, and conditions have been weakening a bit, still growing, but growing at a slowing rate. A spillover to the dominant part of the economy, non-manufacturing, services activity, very labor intensive, a lot of hiring there. And as that growth has weakened, there is concern that job growth may weaken, and that's an important driver of consumer spending, which on the demand side of the ledger has been the main driver of economic growth in the economy.
And do you think our Fed chairman is doing a decent job?
Well, I think the communication could be a bit better. There has been some flip-flopping out there. Admittedly, he, like the rest of us, has been broadsided a bit by changing events. But I think there was a little complacency as the Fed was trying to, what we call, normalize rates, move them up in 2018 about some weakness in the economy. I mean, the pressure, the political pressure, is certainly unwanted and could do damage down the road. But I think the president had a point at the time. The economy may not be that resilient to those increases in rates. And the Fed, I think, was a little, I wouldn't call it cavalier. They're always on watch, but I don't think there was the sensitivity that there could have been until they were forced to reverse direction.
Gotcha. Hey, Gary, we have to cut to another break.
Yeah.
Actually, one of the reasons I was asking that is I'm wondering if we have to bring back Paul Volcker. All right.
Well, he was one of the, we can get into that a little bit. One of the better governors.
There you go.
Reserve.
All right. Here's our second trivia question. And then I know, Gary, you're going to have to go pretty soon. Maybe we'll have you on for another segment or a half segment, and then you'll have to go. I understand.
Sure.
Okay. Second trivia question is, which film features the line, "I could have been a contender"? All right. Call 888-912-1190. Be the first caller with the correct answer. You're going to win that tanning certificate. Stay with us. The Best of Investing will be right back. All right.
That one I know.
That one you know. All right. We'll let you
answer. I'm an old guy.
Yeah.
You want the answer, or you?
No, you can surprise us when we come on back on.
Okay, sounds good.
Yeah, we just need to.
That's fine.
Tidy up.
Yeah, Paul Volcker was. As a regulator, I don't know. The Volcker rule, of course, you're hearing this from someone who works for a big bank, but there were some problems, I think, with that.
Sure.
But as a Fed chairman, he had to do what he had to do, and he did it. Believe it or not, he used the same dentist I did. So I was in the dentist's office quite a bit when I worked in Washington.
Oh, that's funny.
Oh, that's funny. Wow.
Actually, my daughter's going to George Washington University. She's going to be in the international economics.
Oh, yeah, great school for that. I lived literally adjacent to that school years ago.
Yes, it's like a stone's throw from the White House. So
it's not too far.
Yeah.
It's a really nice neighborhood, and I lived on Virginia Avenue and I think 22nd Street, and right up the block. There was a lot of construction at the time.
Fortunately or unfortunately for me, August 19th, nice hot August nights in D.C. I get to help move her in.
Oh,
I know you don't envy me for
we're in
that.
Washington.
Exactly. Okay, here we go.
Okay.
Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hoff, and our special guest, Gary Schlossberg, who is Wells Fargo's chief economist. Second trivia question was, which film features the line, "I could have been a contender"?
Gary, you know that one?
I think it was On the Waterfront.
It is On the Waterfront.
I didn't know that one.
I think it was 1952.
Yeah, I don't have the year, but I'll trust you on that.
So I got to share with you, Gary. So I'm a Wells Fargo client, and I have a really good mortgage specialist I used here out of San Francisco to help me refinance my home recently. And she got me a jumbo 7-1 ARM, which is for you listeners, a variable rate loan, fixed for 7 years. And we closed just recently, just the end of last month, at 3.25. And I thought that was just a great rate, given where you're seeing and what people are now potentially predicting about long-term rates. Do you think I might have an opportunity to maybe even refinance that into a better rate in the coming months?
Well, you don't want to take what I say to the bank, given my track record. Given that the Federal Reserve, the odds of at least another cut in interest rates at the September 18th FOMC policy meeting, those odds are going up again. In fact, in the Fed funds futures market, they're still at 100%, and the probability of a half percentage point cut has gone up a bit over the past couple of days. I don't think that's going to happen, but a lot can happen between now and then. It really depends on the economy. But I would say that depending on how this trade battle with China plays out, that could have an increasingly serious effect, apparent effect, on the economy if the spillover to services continues to build. And in that case, we could see more rate cutting into 2020, pretty much what the market is for. They're forecasting a recession, 4 or 5 rate cuts between now and early 2021. I don't think that's going to happen, but certainly the economy seems to be tiptoeing in that direction. Hopefully it'll improve.
I know you work on a national basis, Gary, for Wells Fargo, and when you talk about the economy, you're probably talking, probably from a nationwide perspective. But here in California, of course, we're, and on our show here, we talk a lot about California real estate, and I know we tend to be maybe wear rose-colored glasses here on this show. And I know personally, I'm a real estate lender. I'm still pretty bullish on California real estate. Anything that you know and see that gives you any concern about where we are with here in California with our real estate market?
Well, fundamentally, there's a housing shortage in many parts of the state, so that tends to provide a good underpinning. When you marry that with the fact that we've got a healthy economy, at least for the moment, tech-driven, here in the Bay Area, one of the stronger areas of the state, and we have mortgage rates moving lower, that's certainly a positive. Now, on the margin, you're seeing some erosion because houses are becoming so expensive that even tech workers they're been reports of tech workers migrating up to Seattle, which isn't all that cheap either, but it is a healthy economy, and housing is a little bit more affordable. I might add that if we do go through the ringer on the economy, you could see prices soften for a time. But again, I think the downside, certainly here in the Bay Area, I think would be limited by tight supply. So unless you really get an unraveling of the economy, given that it's geared toward tech, I think any decline would be fairly limited. I remember during the real estate bust in the late 80s, early 90s, down the peninsula, home prices for a very short period of time dropped 30 to 35%. That was in a 6-month period. Within 6 months, you had a roll-in. People in the East Bay and the exurbs began to roll in. I'm not sure who they sold their homes to, but because affordability improved, you had this backfill, and in no time at all, prices had rebounded. So you don't want to be complacent. Things can happen, but when you look at the supply and the demand balance, unless something dramatic happens with mortgage rates, I think we're in a reasonably good market. Now, one issue is the high home prices mean that down payments are very high, and that affects the first-time home buyer, which is feeding the base. I know trade-up demand has been very strong. You may have a better read on this than I do, but that nationwide, at least, is an area of concern, that these down payments are really dampening demand by first-time home buyers, even as mortgage rates have fallen.
You know, as short-term lenders, you know, we keep our, you know, ear to the ground when it comes to valuations, and I'm a little bit nervous, and have been, and shared on the show, nervousness over prices per square foot, particularly from San Francisco to San Jose, approaching and exceeding $2,000 a square foot. And I always wonder, you know, if we have a hiccup in tech, and anything happens to, you know, hiring practices or companies up and leave, I'm just wondering if there's much support for that high evaluation.
I mean, only if your material costs and labor costs go up so much that, you know, the margin for a developer is so thin.
Yeah, so I guess where I'm going with that is that, you know, California is a very large market. Even the Bay Area is a large market, and I just, you know, there are pockets where prices per square foot in the Bay Area are still $500 a square foot, and then when you hit $2,000 a square foot in the Silicon Valley area, I just wonder if we might see, you know, pockets of, you know, more volatility in the next recession than maybe we might expect today.
Well, I don't want to sound like a spokesperson for the real estate industry, but you know, there is that shortage. The shortage persists. Businesses, in all likelihood, we could go through a correction in tech, and that could ripple through the housing market. Although tech's longer-term prospects are reasonably good, I would say very bright, just considering some of the advanced tech areas, sectors, and biotech as well in the pipeline, whether it's here or elsewhere. That should remain a dynamic industry. Clearly, through there might be some hiccups, and that would show up in the housing market. But you do, I think, longer term, you still have that underpinning from tech, and we have a core and some attributes: the educational system, the entrepreneurship, the local economy. The core that we have in tech is strong enough that acts to retain that industry. You can't simply move away to, say, the middle of the country and establish a company. You could move up to Nevada, you know, set up manufacturing. But I think that's one reason why the demise of the tech industry, while we've talked about it over the years, never really developed to fruition. You move up the value-added ladder, and that's where the opportunity is. And I got to believe that's going to be an underpinning to housing. So a hiccup, yes, maybe more severe than we're expecting, but between the supply and the underlying backbone of our local economy and the ability to retain those tech companies, I believe, should work in favor of the market. Great opportunity to be eating crow a year from now, but that's how I see it shaping up.
Gary, thank you so much. We're going to cut to another break. I know your time is limited. You said you're going to have to go after this. So thank you again so much.
Thanks.
It's Gary Schlossberg, Wells Fargo Chief Economist, joining us today.
Thanks, Gary.
Thanks, Gary. Bye-bye.
Bye-bye.
All right, that was good.
Great stuff.
All right.
I'm looking forward to decomposing some of that stuff in the next segment.
Exactly. Okay. Third trivia question. Whose tombstone features the inscription, That's all, folks. All right. Call 888-912-1190. Be the first caller with correct answer. You're going to win that tanning certificate. Don't touch that dial. The best of investing will be right back.
I said decomposing, but deconstructing.
I know. You're not dead. And then we, want to get into. Do you have any deal of the week? Because I do have an email question.
Yeah, just give me the email question.
Okay, I heard you mention about a 1-year hold on your fund, but can you add to it without starting a new 1-year period?
Oh, perfect. Okay. Yeah, let's just. Let's start by just deconstructing a little bit,
okay.
not decomposing.
That's good, man. That's
Gary's great,
and the timing of it.
Yeah.
I mean, can you imagine being an investor in Germany? I mean, I got to get the money out of here.
Yeah, if you had more time, because I read an article about that one of the reasons why the long-term rates look like they're likely to drop is not necessarily because of the prime cut rate itself, but the fact that they've stopped the they had quantitative easing, and then they said, well, now we're going to do quantitative tightening. Well, now they're saying we're going to stop that for the moment. They're going to kind of let that.
Wow.
And so the expectation that they were going to be selling, and now it looks like they're going to stop selling for a bit. Before they were buying like crazy with the quantitative easing, buying out tons and tons and tons, and now they're stopping, and then they were selling, and now they're stopping on the sales. So I forget what the terminology is for that.
It's called funny money. Funny money and
That's right. It's funny. I got that song on my YouTube clip. I can't play that. It's too bad we don't have a board here. We can we can really have exciting.
That's true.
Radio. So we got 8:48 on the next one.
Correct.
Yeah, that's good. I'm decomposing as I'm sitting.
Yeah, that's what. In fact, that's what Beethoven's doing in his grave right now. He's decomposing.
Right. That's right.
Okay. I knew. I'm all. He's gonna get that. He's gonna get that.
Yes, he is. Yes.
All right. Here we go. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hunt. That was very good information from Gary Schlossberg.
Indeed.
Wells Fargo chief economist. Always love when he can join us. All right, third trivia question. Whose tombstone features the inscription, "That's all, folks"? Let me try this again. That's all, folks.
I forget his name.
Mel Blanc.
Oh, that's right. Mel Blanc.
I figured if I started that off, it would be a little too easy to guess.
So I told the audience at the end of the Gary Schlossberg interview, we would decompose that when we got to deconstruct. And no, it's and who did you say was decomposing in his grave?
Beethoven is decomposing in his grave.
We had too much fun during the commercial.
Yeah, that's true.
No, great stuff from Gary. I was actually really thrilled to hear him talk about how really confident he feels about the Bay Area economy and real estate in the Bay Area. I kind of threw him what I thought was a softball that would allowed him to to fire back if he was concerned about some of the high prices per square foot and whether they're sustainable and maybe susceptible in the next downturn. And he didn't really and he said a lot of the things that we've been saying here for years, which is, look, they're just not building new homes. It's just crazy. They're doing things like allowing you to build ADUs, accessory dwelling units, so-called granny units or in-law units. But, besides that, they're just, not a week goes by where I don't see an article in the paper about some local organization, putting up a lawsuit to stop yet another building project of significant size.
Not in my backyard.
Yeah, I know, the whole Whitney thing. So, so really, really interesting. And, it's amazing. I was reading, we didn't get a chance to really dive too deep into some of the reasons behind why experts are believing that long-term rates and hence mortgage rates are going to once again dip down, and we may see yet another extremely unexpected. I thought for sure we were done with the refinance booms, and we've had so many of them over the last 5 years, and it looks like we're going to enter into yet another potentially historically low mortgage rate market in the coming months. A lot depends on what happens with China and what happens with quantitative easing, which they're stopping the sales.
So I remember, okay, this was the first rate cut in like 10 years.
Mhm.
How many rate increases did we have over that?
Oh,
10-year
good question.
period?
I don't know. A
That's
lot.
yeah, there are a lot of little
A
ones
lot
as the
of little
economy was
bumps,
getting
a
better,
quarter here and
right?
a quarter there. Yeah. So anyway, good stuff from Gary Schlossberg, chief economist of Wells Fargo, who he didn't say it outright, but like many, those calls for a recession in 2020 are quietly going away.
Push it off another year.
Push it off another year.
Yeah.
Now it's 2021.
There you go.
And 2022, your next recession, brought to you by.
Yeah. All right, we're going to move on here to the Pacific Private Money Fund. All right,
I got a question for you.
an email comes in and says,
Yeah.
I heard you mention about a 1-year hold on your fund, but you can add to it without starting a new 1-year period. Can you please explain this?
So the listener actually means he's referring to a 1-year lockup. And so whenever you invest in a mortgage fund or just about any kind of private placement is what they're talking about. Funds like the Pacific Private Money Fund are generally put together like private placements. Some are REITs, but for the most part, they're private placements, which really means they're an LLC, and we put together an offering circular and a subscription agreement, an operating agreement. You get to read all of that stuff before you invest,
Yep.
and it's long and it's windy, and but it really talks about how the fund works, how it makes money, how you make money, and one of the many typical structures of a fund like a mortgage pool fund is a lockup period. And years ago, lockup periods used to be longer. It wasn't unusual for you to invest in a fund with a lockup period of 5 to 7 years.
Oh, yeah.
Then it went down to 3 years and then 2 years. In fact, when we started Pacific Private Money Fund, the initial lockup period was 2 years.
Yeah.
And then within the first year, we actually reduced it down to 1 year because what we kind of found was people liked the idea that they could get their money out sooner. But in practice, actually, very few people take their money out. And so what we found is that we've never actually had to charge the penalty, the prepayment or the early withdrawal penalty. No one has ever closed out their account in less than a year. So, but the question was, okay, so you have a 1-year lockup, which means if you open up an account and our minimum opening is $50,000, and if you open up an account, you got to keep that money in there for at least a year. Otherwise, we have a 3% early withdrawal penalty, which again, we've never charged in the 6 years life of the fund to date. But what if I add more money? Does it reset the clock, or does that new money also have its own 1-year lockup? Now, on some funds, it does. Some funds that there is that tag along where, if you open it up, but maybe 6 months later, you throw in another $50,000. Well, the first $50,000 has only 6 months left, but that new $50,000 has a new year. Well, we don't do that. That's just silly, I think. In fact, if it were up to me, we wouldn't have any lockup period just because I think people, the returns we provide in the Pacific Private Money Fund are so, well, I want to say rare. And they are really. I mean,
they're high.
They're high.
Yeah.
Their high yields are trailing 12-month distributed yield in the Pacific Private Money Fund is 7.5%, and that is that's a rare find in a fairly liquid, well-secured real estate mortgage
fund. It's not a negative yield like they have in Europe.
Right, and so we don't penalize investors. Your 12-month lockup period starts the day you open that account, and as many of our investors do, they start out with the minimum. They open up at 50. They get a few distributed yields a few months in. They see my newsletters. They get a chance to kind of get the feel from it. And then oftentimes they will add a substantial increase to their fund. We had one investor that opened up with 50 and within 3 months wrote us a check for $1 million. So we did not. So it doesn't reset the clock at the Pacific Private Money Fund. Your 1 year starts from the day you open your account. And even if you open up multiple accounts with us, we don't keep resetting the clock. We just really want you to understand that we'd rather you don't treat it like a money market account, and because we do lend that money out for 12, 18, and 24-month terms. But generally speaking, what we found is that you treat people well, you do what you say you're going to do, you keep them informed, you send them regular reports, you make it easy, do what you say you're going to do, and they keep the money in. There's not a lot of alternative opportunities for people to earn the kind of yields we're paying. That's in our case secured by real estate mortgages here in mostly here in California.
Very good.
Yeah.
How do people get a hold of you?
So for more information, our website, which we're continuing to add information all the time, is at pacificprivatemoney.com. That's pacificprivatemoney.com. You go to the website, you click on the Invest tab, and there's a bunch of information in there for you. We are adding more information. In fact, we just did a bunch of explainer videos, which with one of our associates, and that we should be uploading those to the website soon. That's to help to explain a little bit easier how it is, what it is we do, what kind of loans we do, why people borrow from us, and how we make money with your money. So,
and in the next segment, we're going to get into that because, if I'm the audience listening and I hear you're earning 7.5% roughly, I'm thinking that means you got to be charging the borrower more than that because you have to make money.
yes, we do.
And I'm thinking, who would borrow at those kind of rates? It sounds too risky.
Yep.
But it's not. And
right. With bank rates going down to back in the threes again,
yeah.
Why would anybody pay the kind of rates we would need to charge in order to pay our investors 7.5%?
Okay, well, stay tuned, and we're going to tell you that in the next segment. You're listening to The Best of Investing. Don't touch that dial. Don't touch it. You heard me. I said don't touch it.
Don't do it.
Don't touch it.
All right. Can I hear myself again? Yes, I can. I'm back. Hey, I pressed you and you went again. Damn it. All right, short segment, 5 minutes.
Yes.
We'll be short and sweet. How do we do it? We decompose.
That's right. Yeah, that's how we do it. Exactly.
We're going to wrap up early. I'll be able to get back to the gym.
Wait a minute, you going all the way back to the
I know, I got to go.
Oh, Mark. The reason I did this like this, I figured you just go home. Hey, come on in. Say hello.
Hey, we got one more.
We're YouTubing. You're on TV right now. Say hello to all the people in TV land.
Talking with Gary Schlossberg, Chief Economist of Wells Fargo Bank.
Oh yeah. How's he doing?
He's fine, thank you.
He's bullish on the economy. Thanks for doing well. I know interest rates are going down again. I can't believe it. It's just amazing. Keep talking about that.
So September it's going to go down again.
I think I got a 4 in my home mortgage. Is 4.2.
Are you 30-year fixed?
Yeah.
Yeah. So I did a 7/1 arm, thinking that I might not keep it for that long, and I'm at 3 1/4.
Yeah. No, I'm definitely a 30-year. I wonder if I can get below, if it's worth refining.
Probably.
I think they're going to go down. I think the 30-year fix is going to go back down in the threes again, because everyone's saying that because they what's the reverse of quantitative easing? It's there's a name for it. It's quantitative. Is it tightening or whatever? But
it's quantitative tightening.
Yeah, they're not. They put that on hold in addition to cutting the short-term rates, which has got the long-term rates just falling to the floor. So
next month then, huh? What's that guy's name?
Gary Schlossberg.
No, the guy.
Rob.
Yeah. I was going to
Rob Spinoza.
Yeah.
Yeah, Rob would know. I mean, well, actually, no one knows. I mean,
right.
it changes daily, like the stock market.
But you might want to say, if rates go down, what do you expect?
Yeah, so I should probably get prepped if I'm in it, because you have to go through all bullshit. You can not like the old days.
It takes 90 days.
You're on. See?
You're actually recording this?
Yeah, it's streaming live. I can't edit it. So shut your freaking mouth.
I always want to do a porno.
Yeah.
Oh, goodness. Okay.
So you're working on, you heading out?
Yeah, I'm actually going to do a little mini 4 days away. Well,
Nice.
I'm going to go to Grass Valley. A friend of mine lives up there, but just Friday at noon, come home Monday at noon.
Mm-hmm.
But I've had just no time off.
I know, me neither. I'm going to Hawaii for all of 4 days next week, but it's like the only thing I've done all summer.
Yeah, I've just my brother and I talked about going away. I'm like, I have.
Yeah.
Unlike him.
So my daughter Marie Catholic starts tomorrow. This new school.
Oh, does it really?
Yeah. And so next week is a full week, which means Lisa's got to be here every day to do, make her meals.
That's so early.
Get her ballet bag ready. So we're, so summer's over for us.
August 9th?
I know.
She's junior, right?
She's senior.
Junior?
Yeah.
That's good. That's right.
I know.
August 9th.
I know that's just...
I'll show you a picture of her so you guys, I don't think you've seen one of her lately. She's got her mom's beauty.
Yeah.
Where's Christina? Okay, where's the...
Anybody get that bat? Jeez.
That's something. She's very photogenic.
Yeah, she is.
Yeah.
And
I love date of birth 2001.
I know, right before 9/11.
Oh, that's
Yeah, she was born 2 weeks before 9/11.
wow. Yeah, very
Yeah.
pretty.
She didn't get your looks.
No, God, no.
Not just no, but God no. Yeah, no, she's very, very pretty.
Oh, God. Yeah.
Wow.
Yeah, she's got that kind of, like you said, that kind of charisma look.
Yeah.
Yeah.
That
Yeah.
je ne sais quoi.
Yeah.
I don't know what it means, but it's French, so I'm looking to it.
All right, we're finishing up.
All right.
Okay. Ciao, guys.
Thanks,
See you,
sir.
Dave. All right, 5:10.
Okay. Teasing the audience. Teasing. Oh yeah. Why would anyone borrow?
Yeah.
All right. Does this make? Yeah. It's 5:10.
What do we charge to produce a 7.5%
Gotcha.
yield?
Ready?
Yep.
Not yet. Okay. Ready? 1, 2, 3, go. Welcome back to the best of investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn.
Indeed.
Indeed. Didn't have a trivia question, but Mark, we were telling the audience when we came back, we were going to kind of explain if you're able to pay 7.5%+ to the investors, how much are you charging these borrowers? And
Right,
why
so-
would anyone pay that?
Right. So our mortgage pool fund, the Pacific Private Money Fund, the trailing 12-month distributed yield to our investors to date is roughly 7.5%. So if we're paying our investors 7.5%, we got to make a profit there too. I mean, there's a management fee. You know, we got to service the loans. We got to pay the fund administrator. We got to pay our CPA to do the tax returns. We got to do the fund audit every year. That costs money. So what are we charging? Well, we are charging between 9 and 10% for our money.
And who would borrow at those kind of rates?
Well, it is high, especially when mortgage rates are going to go below 4 again. And we don't think our rates are going to go down a whole heck of a lot more, although they may go down a little bit more. But to produce that 7.5% yield, yes, we got to charge rates in the 9s, and then a couple of points, 1.5 to 2.5 points on average. And the reason we can get that is that we occupy a niche in the loan demand space that serves people who need money fast. It also serves people who need money to buy real estate and can't get it from the bank, regardless of the 4% or less mortgage rates. And there's a lot of reasons why people can't get money from the bank. In the Bay Area, we have a lot of self-employed people, and self-employed people find it really difficult, especially to get purchase money loans. And a purchase money loan is exactly what it sounds like. It's you're going to buy real estate, and because we're in a competitive market, sellers don't give you a lot of time to close. In fact, sellers love it when you make an offer to close in, say, 21 days. Cash buyers are typical to do that. And if you want to compete with a cash buyer and use financing, and you offer too much longer than 21 to 30 days, you're probably not going to get that contract. So the way a lot of buyers of real estate who need financing get away with aggressive offers and short closing periods is they use companies like Pacific Private Money to provide them with a short-term bridge loan. And yes, it costs more, but it's a tool to allow them to get the real estate. And especially if you're self-employed and it's going to take probably 90 days and maybe even 120 days now to get a bank loan, because with rates going lower again, there's going to be yet another bumps rush for refinancing. So if you call your mortgage agent, they're going to tell you probably, well, we're adding a couple of weeks on to our expected closing times because we're getting this rush of loan requests. So the reason why, again, just to kind of circle back, is that if you want to close quickly, you're probably not going to be able to do that with bank financing. If you're self-employed, you can get bank financing, but maybe not a purchase loan. Maybe you use us for a bridge loan to capture the property, get it in your name. Now you've got the time to put together all the stuff you need to do to prove your income, and maybe you got to move some money around. Maybe you got to let it sit in an account for a while. They call that seasoning, or create reserves for yourself, because in the Bay Area, we're in a pretty much a jumbo market, loan market here. And, banks want to see reserves. They want to see seasoning. They want to see your income. They want to see lots and lots of things. And it takes time to put that together. And yet another reason is, maybe you're going through a divorce. Banks hate making loans to people who are going through a divorce. Well, where's the husband going to move to? He wants to buy a house to move into. We help a lot of people with those. What if mom and pa die and they leave their house to the siblings, and one wants to sell and the other one wants to keep it? Where do we get a loan to buy that? Well, again, banks aren't usually thrilled with doing, loans to trusts or to to estates. And again, that's something that a lot of attorneys send business our way. So there's just, it's just a surprising number of situations where our money, albeit expensive, is convenient and easy and fast and friendly. We make it, we're fast, friendly, and reliable at Pacific Private Money. And for more information, go to pacificprivatemoney.com. I know we got to wrap it up because we're out of time.
Yeah, thanks, Mark. Appreciate it. Here's our thoughts for the day. My motto: think like a proton and stay positive. I like that. And if at first you don't succeed, skydiving is not for you. Right?
Indeed.
All right. This was a good show. Gary Schlossberg from Wells Fargo, the chief economist. How lucky were we to have him on? Looks like we're not going to be headed into a recession this coming year, which is good. So tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Oh, that's all that.
Right on the money.
6 minutes left to go on this guy here.
Okay.
All those swear words you were thinking about, forget them. Just forget them. I just can't believe the Roman Catholics starting soon. That is crazy.
Yeah. So 8 week summer instead of 12 weeks.
But then you'll get.
But they have a lot of time off during the school year, so that's really good.
Nice.
So I guess Gary is here in the Bay Area.
Yeah.
For some reason, I spaced out and thought he might have been in Washington because he was talking about how he lived there.
But no, yeah, you lived there, but now he's in.
But he does, as the chief economist for the whole bank, he does have to take kind of a nationwide view, and a lot of what he deals with day to day is kind of international in scope because the bank has the bank's national and international. So, but it's nice to hear him kind of opine about the Bay Area and the fact that will we or won't we? And I also like that he said, because I am seeing also a lot of people going, oh, inverted yield curve means we're heading for a recession. And it's just, again, people want to say something, right? And everyone thinks they're an expert. And the inverted yield curve has bbeen a leading indicator in prior cycles of predicting a recession soon, but
there's a factors this year.
There's just and it's funny you said I hate saying things are different. But things are different. Things are different every cycle.
We never had negative yields in the 90s and 70s, 80s, which it wasn't like that.
Yep.
So where's Mom?
Boulder, Colorado.
Oh, is he visiting his sister or something?
Yeah.
Oh, okay.
Yeah. So
we had probably last vacation before kids go back to school type of thing.
Yes, and my trip has nothing to do with school, vacation, or anything. I'm just going.
That's right.
I'm out of here.
As you should.
Stop me.
So it looks like we're going to do a loan next week, which will be good.
Yeah, finally.
Yeah, I know. It's too many of these ones are like, later. Okay, so now I gotta get this one. I'm gonna send this to. Let's see, we got this and this and this. And this. Okay.
All right. Are we almost done, or are we done?
We are almost done.
Is it live stream?
It's live streaming, yeah. So you can tell people, hey, you can watch us now. So I got this, I got this stupid foreclosure. It's been going on for a year. Well, not the foreclosure. I mean, let's put it this way: the last payment I got, June of 2018.
Yeah.
June. And supposedly it's been dismissed now, so we can go to foreclosure, but the judge has to enter it.
What are we talking about?
Gonzalez in the Petaluma.
Oh, so wow, that was a fast relief from stay.
Well, no, it wasn't relief from stay. It was he filed and
dismissed it.
he dismissed because he didn't pay
He
his
filed,
$100.
he filed to stop it and then didn't do what he needed to do.
Correct.
Oh my goodness.
Yeah,
Wow.
he didn't pay the fees. He didn't pay anything.
So we had a foreclosure with where Mitch, I won't say the last time we were live streaming, but anyway, longtime client, just a little $150,000 loan, first position on a TIC in San Francisco, and went all the way to the day before. They filed a 13.
Yeah.
Now,
this was
we immediately sent the paperwork to Gerasi and said, hey, open up a file and let's get relief from stay here.
Yeah.
And did, but
oh, yeah,
it's
actually got
interesting.
relief from stay?
Well, we don't. It just happened last week.
Oh, it just happened last week.
Yeah,
Okay.
yeah. So I guess we'll find out.
What's the property worth?
You know what? I don't know. And ticks are hard because they're not quite condos. But at the time we made the loan, which was in 2012, and this was a 10-year loan that Mitch agreed to make.
Yeah.
And and I think it was like $400,000 or $500,000 was the
back then
valuation back then.
Oh, it's like 700, 800, 900.
Yeah.
Now the thing is, it's TIC, so there's some other owner in there.
Well, yeah, the TIC thing we had to do was paperwork. Actually, the Shear Law Group helped us with that because we've always, any time we have a TIC or a co-op, they help us with how to write the note, the deed of trust, and how that gets recorded.
Gotcha.
And I can't even speak legally about the ramifications of now being the owner. Do you have co-owners, or because it's
well, no, you foreclose on the whole thing. You wipe both out, don't you? Because your loan gets the whole thing.
Yeah, well, but it's a TIC unit. So if there's 3 units in the building and each TIC owner has an undivided share, but it's like it's a hybrid. It's not quite.
Gotcha.
It's not a tenancy in common of one property.
Probably why a lot of banks won't do it.
It's the way that San Francisco has figured out how to do condos. Or when you can't condominiumize a building, you can actually, with permission, you can do